next panel. The Hello, everyone. Good afternoon. This is our next panel, VC investing out of the winter. Today, we will talk about the new investment trend and how we are going to face this market. Winter has definitely here. With the current flow of the market, definitely a lot has happened. But we can also face the recent tragedy as the new stabilization of our market. Going forward, crypto market can be stronger and have more stabilization. Historically speaking, VC actually has better returns in the bear market when the valuation slows down and more approach, more access to the greater team, and also lower OPEX for the team going forward. And this is a time when VCs, including our fund, are still investing and still creating value. So for venture capital, we not only provide capital supporting great teams is also part of our mission and a lot of reasons why we joined the industry at the very first place. But with winter coming, how can we be optimistic in this market while become rational when the bull market finally comes? With this notion in mind, today we have invited seasoned investors to join the panel to share their thoughts about how they have changed their investments. What is their forecast going forward? So before we started, maybe each of our honored panelists can give us a short intro about their fund. Maybe start with Anthony. Can you can you introduce about your fund?
Sure. Hi, everyone. Anthony here from Newman Capital. I'll kind of keep it short because we were talking about how people spend like long time introducing the fund. We're a seed stage to pre-A or even a early stage VCs, mostly focused in the consumer space and Web3 consumer by that. So yeah.
Hi everyone, my name is Carl. I'm a partner and head of research at Six Man Ventures. We're an early stage Web3 fund investing across different, across the crypto landscape and across different ecosystems. I think what really makes us unique is everyone on the team is all prior entrepreneurs or builders, and so we really tend to specialize in founder mentorship, go-to-market, product strategy, and tokenomics research.
Hi, Julia here from Alpha Lab Capital. We're a crypto-native market-making and trading firm. We've been around since 2017, and I head up the venture and services arm of our business. So our specialty as an investor is, one, that we know the space, being operators for the past 5 years, and two, we're market makers. So there's a lot of services and ways that we can help our portfolio companies.
Hi, my name is Miko. I'm with Gumi Cryptos Capital. We deployed our first fund into the crypto winter of 2018, $21 million fund, and we recently raised 110. So we're deploying it now into very early stage projects. So if you're just kind of forming your teams out there in the hallway right now, definitely come talk to us, and we'll be happy to, hang out. Thank you.
Yeah, so my name is Andrea Chang. I'm partner at NGC Ventures. Our fund is based in Singapore. We have established since 2018. And our focus is mainly infrastructure, also metaverse and GameFi infrastructure. So going to the first question, let's see from the bigger picture. As the winter comes, how does your investment change during bull market? Is it a rapid change or is it a gradual change or any obvious change? Can you share with us what makes the difference?
Yeah, because of our experience in the previous crypto winter, basically in the bull market, we slow down. And in the bear market, we speed up. So we're more actively deploying now, and we're very excited to see all these amazing high conviction founders coming out of the woodwork. So that's what's exciting to us. I think the bull market, you have lots of low conviction founders who are just kind of like, oh, I'm launching my own metaverse, and I don't understand that. So for us, like, we're very excited to be here, and I think that's the change, is we're deploying more and faster in the bear than in a bull.
Yeah, for us, we maintain the exact same, investment evaluation process, underwriting process, due diligence. That is exactly the same in all market conditions. But as Miko was alluding to, in a bull market, you have a day, sometimes 2 days before something closes, right? And you don't really have time to DD the way that you should. In a bear market, you have more time. You have, I think, higher quality founders. With all the tech layoffs that have been happening recently, I expect to see a lot more of those people deciding that entrepreneurship is better than a job at a big tech company. So I expect to see more quality projects. So we're very excited to be investing in the bear market.
Yeah, I really want to echo some of those points, especially around having time to get to know the founder. It's been very real. 48 hours to make a decision. You're trying to run a process through 4 partners. It's really challenging. Versus now, we actually get to know the builders. The other thing I'd add is in the bear market, we actually get a chance to take bigger swings. In the bull market, everything gets so marked up to, I think, unsustainable levels. And as part of that, from a risk return perspective, you really just can't justify some of the, likelihood of outcomes with the current valuation of these companies and what you might be able to get on the other side of it. But now, things have slowed down. There's less urgency in the space, and we can really get back to building. And so we actually can invest and partner with founders who can build for longer periods of time before they deploy, instead of feeling rushed to bring things to market to try to catch the next news cycle that oftentimes happens during the bull market.
Yeah, I would agree most of the other panelists. And from our perspective, we actually started the fund in the bull market. And it was very fortunate that we stay rational. And I would almost say that during the bull market, we didn't really make a lot of investment. And it was starting sort of like a slow transition, right? Like starting from late last year, we kind of speed up our investment. And I think right now it's full steam ahead. We are in a winter, but what I like about kind of like the current environment is that founders are more rational, and when they are more rational, they are willing to work with investors in understanding what they're trying to build, understanding the vision, and that oftentimes translate into long-term conviction for us as an investors, because we really understand the founders. And I think for my personal background, also as a founder before, building in a bear market is extremely difficult, and you really have to have the convictions. And as we're working in new technology space, I think it's more like a marathon, than like an actual race. When you get exhausted, your peers also kind of get exhausted. So it's then at that point you kind of sustain and persist. That's when you actually get the rewards. And same thing for investors. So I adding one more point, which is in the bear market, we kind of now see that the batch of 2021, some of the founders are still very high quality, but they're coming back and needing another round of investment. So we as investors also take a look at those deals who the founders are willing to keep on going, even at this really difficult stage.
I just had one quick point to that. I really agree. And probably the most exciting category of founders that we've seen in this this bear market so far is experienced Web3 executives or managers at existing Web3 companies that see gaps in the way their current companies are approaching it and say, you know what, I want to build my own thing in a better way, or I want to learn from the mistakes we made during the last bull market and redo that in a more decentralized, censorship-resistant way natively. And so it's incredibly exciting because I think, you touched on this where in the bull market, you have all these people coming from all over wanting to build crypto projects. They haven't been in this space. They don't really understand the culture. They haven't really proven their dedication to the space. But now we see people who have operated at Web3 companies for 1 to 2 years and want to start their own thing. And so it's a category we're actually willing to pay more for because they're experienced and just have great set of leadership experiences and technical abilities they've just built up during the last bull market.
For our fund, including what I've seen personally, is that there has been more emphasis on revenue. I feel the narrative of revenue wasn't that strong when a lot of teams, they can cash out tokens pretty quickly. But when it comes to emphasis on revenue, it's also about like business model and how they manage the team. So this narrative is definitely stronger. And another thing is that I feel for our team, we have spent more time on researching on the narratives, the new narratives, next big trend itself. It can be, say, app chains, it can be new ecosystem, and it can also even beyond Web3, like recently how AI and maybe the underground metaverse. And I think lastly is like echoing about the point touching upon the founder, the background of founder, is that we see a lot of Web2 background founders actually coming in. Usually they will pair with Web3 advisors or marketing or community people in Web3. So that's for our side. So going on the next question, things we touch upon like bear market. So, and all the investors here have experienced multiple cycles. So can you share with us like what was your previous lesson in the bear market?
Yeah, I think I, out of all of them, are probably the least experienced. I started investing in crypto probably 2017, and these guys are probably earlier in the ICO stage. I think I've learned that hype is not something I should just follow because you only really become a successful investor when you have conviction, and conviction leads to holding investments for an extended period of time. So for me, from the previous cycles, what I've learned, and especially now as more of a consumer Web3 VCs, although we do have some infra and sort of middleware play, is that you really have to focus on the problem and the pain point of what these founders are trying to solve. And oftentimes, everyone is very excited and jumping right to solutions and talk about, hey, this is like the latest tech stack that we have developed, the fastest, the most efficient. But at the end of the day, what problem are you trying to solve? And how realistic is that problem, right? So I'm going to use I call it the metaverse kind of hype narrative. I don't see any pain point in those just yet. So taking the same approach, looking at this bear market or, being in the winter, what's going to be most important for me and taking from the lessons is really understanding the problem, focusing on why are you solving this problem? What is so important that this problem has to be, even more important to be solved now and not like 5 years later or 10 years later. So yeah, I think, that's probably my North Star right now as a consumer Web3 VCs.
I think for us, I think the big lesson is contrarianism, right? Is being contrarian, I think, is super valuable. Like, for example, like we led one of the seed rounds into OpenSea, and at that time, like 2019 timeframe, like there really wasn't any real NFT marketplace to speak of. We also were seed investors into YGG or Yield Guild. Right, so the idea that Gabby was pitching is, what if you had an IGN style kind of gold mining guild that was owned as a workers collective or as a labor union, right? Nobody had ever heard of any of those things before. So for us, like we definitely have acquired a strong taste for contrarian bets, right? Especially when in a bear market, contrarianism takes a lot of guts, but it definitely has a super high risk reward ratio. I think Carl was talking about sort of taking bigger swings. So I think it's probably related.
I think probably the most important thing that I've learned from investing in previous bear markets is just how to be zen. So I'm dating myself, but I started investing personally in 2007, which was a very interesting time to start investing. And I remember, all of the headlines were about like prices plummeting and people getting laid off, and it felt like the sky was falling down. And now, when I talk to people who are younger and for whom this is their first bear market, they feel that way, right? They feel like, oh my God, is this the end? And, from having been through a few cycles, it's not. This is ups and downs are a very natural part of market cycles. It's just like seasons, it comes, it goes. So I think I'm far more zen now than I was, when I was younger, just started investing.
Yeah, and I'll be honest, this is my first time being a professional or like as part of a fund in the bear. So I don't have, I'm going to keep this really short because I don't have a ton of, bears I've been through on the investing side. I have, but not like in the investor's chair. But yeah, this is the best bear market to be investing in because all the core metrics are still extremely high. You look at, the trend of developers, it's continuing to increase. You're continuing to see events like this with fantastic global developers coming together. That wasn't necessarily the case at such scale during prior bear markets. You look at the macro trends, I think from a macro perspective, inflation is still very high. It's still going to keep being high globally for a very long time. And so a lot of the narratives around like sound money and just generally not reliant on central institutions and central bankers is more cogent today than it was during prior bear markets. So from all the data that we see, this is like, we're in a bear market, but it's only that the price is down, not that necessarily the fundamentals have changed. And so to me, it's like almost it's a really easy being investing in this cycle because we have such conviction that we're going to be able to make it through this. But I think my advice to teams that are in the bear market is just continue to solve developer pain points and get back to basics, right? Like really figure out your target customer segment, and really focus on attacking that effectively rather than trying to boil the ocean, which oftentimes can happen during the bull market. And in the bull market, you might be able to sustain yourself on hype and other things. In the bear, you really need to prove yourself via traction, community growth, revenue, some sort of key indicator that you are in fact creating value in the economy.
I think for me, the previous two cycles I've experienced, the market teaches me to be persistent, not only as investors, but also when we work with teams together. And I think another point worth mentioning is about the importance of relationships. Actually, bear market, I feel, is the best time that you make friends in the industry and and know people that are actually still building. Because it means a lot. It takes a lot of character and ability to survive in this market. And because you and the industry friend, you have been through this whole journey, you have some shared pain or shared memory that when the market finally comes, it's the time that you guys can not only earn financial benefits, but also like even lifelong industry partners. Yeah, so that's my takeaway. So zooming in, so what kind of projects are still shipping? And who will weather the winter the best? Who want to start first?
It's kind of touching my point that I mentioned are teams who initially had pain points to solve for. Because for them, their pain points are kind of the North Star, is where they would drive their company, is their mission and the vision. I think this assumption has to be set correctly amongst all the founders, right, when they set this company, and saying that, hey, because all of these assumptions fall into the true bucket, such that we should solve a problem like that. And during the bear market, nothing has changed. I mean, macro-wise, and supposedly, in crypto, in demand, supposedly nothing's changed except the prices are going down. So for those companies, they're shipping. They're working even harder and potentially even hire some of the talent that they see from their competitors to join their team. And I think one more thing I wanted to add are founder who has a purpose on why they're doing that. I'm going to use an example. One of the companies that we invest in, they're on payment. And the founder has been in payment for a very long time. So he's deeply interested in the scene of payment. Unlike, a lot of people when they're diving into Web3 during the bull market, they're just, going for hype. And they might be building, consumer app, but all of a sudden they're trying to, do infrastructure. And of course it would be much harder for them to sustain because, again, this is a marathon. So I think, the teams who have a very strong pain point and even better, a personal connections on what they're building, those are the teams that are shipping.
Let's remember some of the companies that were built during the last couple of crypto winters and bear markets, right? Uniswap, MakerDAO, OpenSea, Nansen, right? Like these companies were all born during winters. And I think in a bear market, you have to have better ideas. You have to be genuinely innovative and genuinely working on something that you're excited to be working on, and you're happy to put your head down and keep working on it as long as you have runway, right? And do everything you can to extend that runway. Alpha Lab Capital, our company, was started in 2017, about 5 months before the bear market set in. And all through 2018 and 2019, we just kept our heads down. We were a very small team. We kept our headcount low. We were just working on our algorithms, working on our infrastructure, working on our technology. And when 2020 came around and the market picked back up again, we were there and we were ready to go. So I think that's the sort of thing that's the sort of attitude that you have to take as a founder during a bear market.
I think one of the things that we've started specializing in is really training entrepreneurs on how to raise capital. We think that the ability to raise capital is actually a very strategic advantage. We actually have over 300 co-investors, institutional venture co-investors. So since we've been around for a little while, over almost 80 portfolio companies. We really do know a lot of folks in the industry. And we just feel like that becomes a really useful value add. Something, because I feel like this is there are people who are amazing at pitching, right? But maybe they're not great at building their company, right? Whereas that's something that we can't teach entrepreneurs how to build their company, right? But we can teach them how to pitch. So that's something where I feel like I can add value. So I'm definitely very opinionated about how to pitch. I have a methodology that I call the magic words. So if you can learn it from someone who's actually doing it every day, I think you can get an advantage. And I think that's in a bear market, I think learning how to raise is worth learning. And it's pretty simple, by the way.
Yeah, sometimes people, consumer applications tend to do better in bull markets than bear markets, just because naturally people are more predispositioned to get in early and experiment with new opportunities. But some people ask me, should I start a consumer application, during the bear market? And the answer is absolutely. Any category of Web3 project can be successful during the bear market. I think the founders need to have more conviction and more passion, because it's going to be more difficult than it is during the bear market. It's going to be less sexy, less fun, but I think absolutely any type and category can be successful. And in addition to raising capital, making sure you maintain the capital you do have. First-time founders in particular want to hire a big team. They want to be able to sponsor events and sort of live that experience of now, instead of being an individual contributor, I'm now a leader. But second-time founders are all about keeping the team as small as possible to preserve runway and be able to actually invest more strategically at specific times or opportunities than just maintaining a broad team. So cash management, number one reason companies fold or die is because they run out of cash. So just make sure as a founder you don't get too overzealous and you keep disciplined on how you use your runway. But that doesn't mean that you shouldn't spend it. If you see a good opportunity, double down there, but spend wisely.
Yeah, I wanted to add on to that point as previous founders. It's actually important to know when you need to put on the speed. So it it is important to survive, but at the same time, you're in a race. You have to be faster than your competitors. So yeah, pitch, sustain, and know when to go.
So how can entrepreneurs decide to continue to raise at a down round or to close shop and return capital to investors?
I'll start with this one because we invested in a company, and then 2 weeks later they got an acquisition offer. And so, they asked us like, well, should we keep building or should we, sell the company? And we asked the founder, well, do you want to keep building? And so, I think the answer is, if you are still extremely driven about your product, like absolutely keep trying to build, trying to pivot, trying to find product market fit in some way. But if you are not, if you're like, hey, I actually am okay with a small exit or a minor exit, and that sort of is indicative that you might not be as passionate about this opportunity, then go ahead and take that, right? It's a great outcome, good opportunity for you and the core team that you built. But, I kind of put it back on the founder and say, well, what do you want to do? Exactly. And kind of whatever your heart is, just follow that. But there's capital there. I think, well, we'd all agree there's tons of capital out there for really good teams and for really, for founders that have the ability to, differentiate and think critically about the space and the pain points that they're solving. So no, there is capital there. The question is, do you have the right narrative and ability to raise that capital, and do you have enough conviction to continue on the journey? Because in the bear market, it is a really hard and sometimes lonely journey.
I mean, I think that the thing not to break is actually trust, right? So to me, we've certainly had multiple cases of basically, returning available capital. One of the first ones we had there was Basecoin. So Basecoin returned 94% of investor capital because they didn't see a forward path, right? So they were like, okay, the thesis is broken. The thing you invested in, it doesn't make sense for us to do. So have the money back, right? So they went on to raise more money, and that's a beautiful story, right? Because they didn't break trust, right? So, if your thesis is broken, you should definitely think about what to do, because there's definitely second, third innings, and there's plenty of stories where people go on to do really wonderful things, right? As long as they don't rug pull their investors.
Yeah, and it's really important to communicate with your investors. I think there's a question around this, so I don't want to say too much, but the worst, I'm hoping or assuming that company was working with you and you had a good view and could help encourage them one way or another. But the worst thing is if a company doesn't write any investor updates, doesn't really engage their investors, and then they're like, hey, I'm in a really bad spot. And it's really hard because you haven't understood the narrative of the business, what they've tried. And then it's hard to go ahead and actually help that founder figure out the best path forward. So, trust with your investors and consistent communication. We expect things to go wrong in a company. That's why we're, early stage investors. There's a lot of risk, but we can, as investors, help navigate that risk if we're in the loop effectively. Yeah,
we expect 90% of the company goes to zero. So it's pretty normal that shit hits the fan, and then we are prepared to help you solve problems. And I think echoing on Miko's point, checking your initial assumptions on why the company should work, and if that assumption has changed, you can either choose to pivot to a different idea, or Basecoin, return the capital and retain the trust that you have from your investors. And a lot of times when you pivot to a different idea, you could find success, and almost all the companies wouldn't be successful in the first go. But one personal experience is that as a ex-founder, I pivoted and I found success. Turns out I didn't like it. I didn't want to build what I was building, and eventually I sold the company because that's just not something I like to do. So I wanted to let the founders know that it's okay that you pivot, find something you don't like, and exit or sell the company or shut it down. Because at the end of the day, if you don't like what you're building, it's very hard to get even for the investors, for them, they're not going to get the venture return because you don't like it and you don't have the passion in it.
To add a positive note, right? We are still seeing companies raising new rounds at higher valuations, and there is, as Carl was saying, there is still capital out there. right? So it's not all doom and gloom.
Okay, going on for the challenges and opportunities, what VCs are looking for as signs of legitimacy, meaning how to prove your project isn't a slow rock. Who wants to start? Nico?
Yeah, I mean, I think this is really important. I think one of the things that we do is we absolutely call references, and we don't just call the ones that entrepreneurs provide, because those are always the best ones. Like, we go off-road and like we try to find out, right? That, I think that's important. And this is probably the biggest alpha that you'll get from me on stage is you need to call references off-road on us, right? Which is, you need to know who's on your cap table, who's investing in you. And like, one of the things that I think is pretty important about this panel is that we've all founded, scaled, and exited companies ourselves, right? This is actually super important, because if you just get someone who's only done like maybe B school and then like investment banking, if you tell them what's really going on in your company and how insane it is, they're just gonna flee in panic, right? Whereas if they've actually built startups before themselves, they will have nerves of steel. Like, they will be like, oh yeah, I've seen that. Okay, that's fine. Okay, we're screwed, but maybe we can live. So figure out who's investing in you, and like call references on them and go off road and call the people they've worked with who haven't been massive giant unicorn successes, right? Because those are all happy stories. Like, call the ones where it's maybe not so happy, didn't turn out so great. How did they do?
I like to use a win-win strategy. So I do call the reference, but what I really like to do is, for example, we're doing a lot of like, SaaS type of model company now, or, a middleware company. I would just send them like a customers, maybe a portfolio companies of ours. And then I would just say like, and then I would check with my portfolio and say, how did you feel? Like, do you like working with these guys? Because in front of investors, they would just say, yeah, I'll do this, that, and whatnot. But when you have a customers in front of your door asking for something and try to actually pay you to use a service, that tells you a lot about the team. And oftentimes you'll be surprised. Out of like maybe 10 companies, only like really 2 to 3 of them deliver, or 2 to 3 of them actually have a good attitude or actually want to work with other companies, and maybe 1 to 2 of them actually deliver. So then I would like say, that's a pretty good sign. Not like, call it a day, but that's a pretty good sign.
I think in addition to, personal references, which is incredibly important, probably the number one thing that we're looking for as, proof of investability is traction, right? Like, are you building products? Do you have some kind of MVP? Do you have alpha customers lined up? Do you have a wait list signed up? Are there actual people who want to use this thing? Have you, done user surveys? Do you understand the problem? I think the days of being able to raise on just a deck and an idea, that's like bull market, right? That's not going to happen here.
I think another source of really, really valuable sort of reference calling is actually your past investors. Maybe not even on this project, but on previous projects. Like, those are all super valuable. That's the reason why you probably shouldn't rug pull your investors, because new investors should be calling the old investors and saying, how was it working with this person? We actually had an entrepreneur that pitched us, and they were like, oh, you know what we're doing is we're doing a recap. Right, so you're going to come in, you're going to get the lion's share. It's going to be awesome for you, and all the investors that are currently on the cap table are going to get screwed. Do you think we want that? Like, do you think we want you to abuse your past investors so that what? You can abuse us next? Like, that's just silly, right? So the idea that we're not zero-sum investors. We are positive sum investors. That's what venture investors should be and have to be, right? So the idea that we're going into a win-lose where we're hosing over these other investors, like, that's just bad. Like, so I guess what I'm trying to say is, don't hose people, and you'll do better. So I don't know.
We were about to do a deal and talk. There's a 3-time founder. So like, everything on paper looked really good. We talked to their prior investors and just heard horrible things. So we were about to do a deal, completely passed. on the insight of prior investors.
That's
so
terrific.
100%.
We've done that too.
Yeah, 100% echo that. On the traction piece, I think the other, my background is in product, and in particular, what I really look for is, do you have a strong hypothesis about what types of customer segments are using your product and why? And in particular, do you have user, narratives or stories or, pieces of feedback that really help guide you? Like, I would much rather have smaller traction number-wise, not a large community, but smaller traction number-wise amongst a dedicated group of users that have not churned and continue to engage with the product than I would like, our Twitter is this, our community is this, we're targeting 4 different customer segments and they're all like disparate. To me, that really doesn't show clarity of thought as a leader, and especially as a product thinker, which a lot of the time the CEO is early on in these companies. So really just, something that's important when we're looking at companies.
Yeah, I stay away from the vanity metrics, because you telling me that you have 1 million users, all of them churn T0, doesn't mean anything to me. So focus on real tractions, focus on actual engagement and how sticky a small, I would say, audience is. I mean, we're all seed early stage investors. We don't expect 1 million, 10 million users. I very much rather, if you have 10 million users, probably not, you could just sustain with a lot of different monetization model. I rather very much see like dedicated users and real metrics. And by showing that, you presenting these metrics and understanding the importance of that, really showcase that you are a product owner, someone who understands how to scale this beyond just the early stage.
And if you're B2B, then we'll absolutely want customer references. Like, we'll absolutely want to talk to them.
100%.
The
So
ones you give and the ones you don't give.
Very good.
So friendly reminder that need to check every number and every customer on your deck, because we will go after them. So following on the previous question, like, what can investors actually do to hold founders accountable?
I'd like to throw out this idea. I don't know if you guys have done it before, but I kind of like stage financing sometimes, when I don't really especially if I'm leading a deal, right? Like, it's a founder that has not proven himself, but I still wanted to give him a chance because he's really sensible. So I'll maybe just throw in like a stage financing super early on round where I'd say, okay, I'll give you X amount if you, kind of like, well, first I'll give you like some initial capital. I'll give you X amount if you deliver the MVP. I'll give you another X amount, if you actually get to beta. So to really get them accountable, and also oftentimes it helps them to really focus on what they should be focusing on. It's not marketing. It's not, Discord building a community. It's really building the product first, right? And I don't know. I don't know if you guys think that's weird. But
I kind of mostly capitulate on holding founders accountable. I have a pretty different contrarian strategy with respect to that, which is that I believe in the worst companies, the investors are driving the car and the founders are in the back seat. Those are the worst companies, right? Because, so it's like, if the investors are the adults, that's actually bad, right? What you want is the entrepreneurs to be not only the adults and not the investors being the kids, but you actually want the entrepreneurs to be the parents and the investors to be their kids, right? So in a sense, like, the idea that the investor is holding the entrepreneur accountable, it's really, for us, it's more selection. It's more selection, which is, we want entrepreneurs who hold themselves accountable. We want entrepreneurs who are, accountable to the market, to their customers, right? And so it's selection. And sometimes it doesn't work. Sometimes you select wrongly, and so the amount of energy it takes to make someone who's not accountable is not. It's just not worth it. It's just not worth it. It's like, okay, that's fail.
I'll talk about this from the perspective of a market maker, right? So something that we saw happening a lot in bull markets is investors, really pushing their teams to generate tokens very early, sometimes before they had a product, and then just getting really early liquidity for the investors and the teams. I think the narrative around that has shifted a lot over the past year. We're seeing a lot of deals change the investment type, right? We're seeing a lot fewer SAFs and a lot more safes, perhaps safes with a token warrant, but investors being willing to take equity rather than saying, I'm expecting you to have a token in 6 to 12 months and I'm expecting to be able to get my money out. It's a very different shift in the expectations that are set for what they want the founding teams to do.
I think if you read the book Super Founders, you'll know that the median time to unicorn is 4 years, right? And then it tapers after about 7, right? And the reason why is 4-year vesting is standard in Silicon Valley, right? So why is 4-year vesting standard? If you look at 7-year taper, 7-year taper is actually the second re-up of vesting, right? So it's 2 vesting cycles. You're not going to make it. Like if you go too longer than that, you won't make it. So like to me, like it is really kind of like this type of motivation and energy, I think, is really important.
Yeah, quick side note, if any investor is pushing you towards a token in 6 months for quick liquidity, do not work with them.
100%. Those fast pump and dump investors, like, put the investors on vesting.
Yeah. So on the, I think, so echo everything that's been set up here. The other thing is just have a conversation. And in particular, before you sign the term sheet, one of the things we've seen I talked about the importance of investor updates previously. 100%, we've analyzed our portfolio, and the ones that send investor updates have outperformed those that don't. And I think for many reasons why that's the case. We were kind of talking as our team, 6-man, we're like, why is it that like investors don't send, like I'm really upset this, founder isn't sending an update. And then I was thinking of like, well, we never told them they should. I mean, like we told them afterwards, but we never said while we were signing the documents, like, look, this is what we expect from you as a founder and like how we're going to work together, because it's really a partnership, right? Like we really want to work with these founders and get into the trenches with them. But likewise, we're going to lay out our expectations. You, builder, founder, 100% should lay out your expectations for what you expect from us, right? And so whether that's, hey, we really want you to be involved in, tokenomics help, or, go to market in particular, like intros to these different types of companies, be extremely explicit about what you want your venture capital investors to do. Because the worst thing you can do is find a firm, not be explicit, and then they're not actually solving the pain points that you as a founder have. So just have the conversation both ways, and then everyone on the other side of the investment, has a very clear expectation on what they should do.
Okay, so going to the final question of today. So what is your outlook for Web3 VC investing in the next year? Like another winter, or spring is finally coming?
I think market timing is extremely opaque, so it's very hard. One of the things that we've benefited from is actually the 4-year Bitcoin halving cycle. So we've definitely raised funds on the highs and like been deploying them on the lows. So I think that's really something to look at. For me, I think we are actually we're in a really intriguing phase where there may be mass adoption coming. I actually am pretty bullish about the Web3 gaming segment. Last year, $7.6 billion went into Web3 gaming. So, I think we are going to have like a lot of mass adoption coming from that investment. So I'm pretty excited about that.
Nobody knows. I mean, like the smartest, macro investors in the world are wrong all the time. So I have no idea if it's going to be winter for 2 more years, or if it's going to be, summer. It's going to be like 80 degrees outside when I walk outside today. What I do know is like we're long-term investors, so we're not worried about the next 6 months to a year. We're really looking at like where, what are the underlying fundamentals and like the main, again, pain points or capabilities that you're providing, and that's what we're investing in.
Yeah, I would like to echo both of what they said. I think for us, one of the main thesis or one of the core investment direction is new users. We think currently there is not enough users or new users in the Web3 space. It could be gaming because there's so much money and financing, supporting studio, bringing new games. And I think it's the natural, progressions of new users. And for gamers, their mind share of and switching costs is less than, let's say, other type of application like social. They could very much just try out a new game, which happens to be on Web3. So it's a natural progressions for gaming to pick up a little bit more traction. But I wouldn't say there is something out of the blues in getting traction. So it's like, who knows? But for us, we're pretty sure that it's not going to be one of the 2017, 2020, like it's not going to be immediate adoption. It's going to, it might very well be like a slow ride. It's a slow ride up. It's a little bit more healthy because the fundamentals are getting better, usabilities are getting better. So I think 2023 on, it's going to be actual usage. So it might not be an overnight success like we have seen in DeFi summer or ICOs or previous cycles that we have seen.
I think regardless of how long this crypto winter and the cycle lasts, what we expect to see coming out of it is some genuine innovation and some real solutions to some of the many problems that still exist in the space. I think, again, if you look back at the last cycle and what came out of that, right? We had AMMs coming out of that. We had DeFi summer coming out of that. We had, the NFTs and DAOs and all of these things that were kind of at a slow burn for a long time before it took off, right? Uniswap, I think, was launched in 2018, right? And existed for a year and a half before DeFi summer took off. So just, regardless of how long the cycle lasts, if you're building something genuinely innovative and that's solving actual problems, the timing will come for you.
Okay, for our fund, we will look more into the entrance of new market as well. It can be gaming, can be social-fi, but specifically for projects that can have a wealth generation effect. So new token economics, new products per se. So yeah, our time has up. Thank you all for the honored panelists. Hope you have a good day.
Thank you.